Bitcoin didn't just stumble, it was pushed. At least that's what millions of people now believe. Because when Bitcoin fell from $126,000 to $80,000 within weeks, the fear was real, but the silence was louder. No clear catalyst, no headline, no smoking gun, and that's when a new theory began to spread. What if this wasn't just a market correction? What if someone or something wanted Bitcoin companies to bleed? A mysterious MSCI memo, a sudden margin rule change from America's most powerful bank, a narrative that exploded across finance Twitter like wildfire. Tonight we're going to follow the timeline, uncover the players, and ask the only question that matters. Why is JP Morgan tightening its grip on Bitcoin treasury companies right now? And what truth are they trying to hide? Welcome to FX DNA. I'm your host, Hurley. Let's get into it. Over the last month, Bitcoin went through one of the sharpest reversals since 2022. A clean run to a fresh all-time high, wiped out by a violent 35% pullback. But something was different this time. No May, Gox dump. No ETF rejection. No regulatory crackdown. It was a narrative vacuum, the kind that forces people to search for explanations in the shadows. And that's exactly when a post from an ex-user named Marilyn Hoddle went viral. She wasn't a reporter, not an insider, just someone connecting dots that millions of people suddenly found a little too convenient. Her claim: a silent financial war was unfolding between a pro-Bitcoin White House and the largest bank in the United States. And the battlefield wasn't Bitcoin itself, it was Bitcoin treasury companies. The companies proving you can use Wall Street tools against Wall Street. And at the center of that battlefield, MicroStrategy. So why did JP Morgan suddenly become the villain in this story? It began quietly, almost invisibly, with a change in internal margin requirements. Clients reported that JP Morgan had moved margin on MSTR-backed loans from 50% to 95%. An extreme unprecedented increase, one that forced leveraged holders to unwind positions, sell shares, or move assets out of JPM custody. Then months later, another piece of the puzzle surfaced. A memo from MSCI, the global indexing giant overseeing trillions in passive flows. The memo suggested excluding companies whose balance sheets were majority Bitcoin. Harmless maybe, but here's the suspicious part. The memo had been public for weeks, yet JP Morgan suddenly began circulating it aggressively, right when Bitcoin... Coincidence timing, or something far more orchestrated. Nobody knew for sure, but the narrative had found its spark. To understand why this matters, we need to break it down simply. MSCI builds the indexes that trillions of dollars track. If MSCI removes a stock from a major index funds must sell, ETFs must rebalance, pension funds must adjust. Billions can be forced out instantly. That means if MSCI considers Bitcoin treasury companies as non-standard or high-risk even temporarily, every company following MicroStrategy's path could face sudden outflows. Strategy. MetaNet. Lightning-focused firms. Any company storing Bitcoin on their balance sheet. And JP Morgan publicizing this memo during a panic was like throwing gasoline on a fear that didn't need help spreading. Because if passive funds are forced to sell, the price impact is real. Temporary, but real. That's why this story hit a nerve. Not because the memo was final. Not because JP Morgan declared war. But because it exposed something uncomfortable. Legacy financial institutions still don't know how to digest Bitcoin, and some aren't even trying. Once the theory surfaced, it exploded across Twitter X. Boycott JP Morgan started trending. Grant Cardone announced he pulled $20 million from Chase and was suing them. Strike CEO Jack Mallers revealed that he and his father's company had been debanked by JP Morgan with no explanation. Then came the media hits. Jamie Dimon called Bitcoin a pet rock again. Jack Mallers fired back on live television saying, "I don't know why anyone cares what Jeffrey Epstein's banker thinks about Bitcoin." And then unexpectedly, Eric Trump stepped into the conversation. On CNBC, he exposed how major banks had debanked their family too. We had to get into cryptocurrency. We had no banks. The same people who canceled us now want us back. Crypto solves what these banks have weaponized. Millions watched that clip. Millions agreed. This didn't look like a conspiracy anymore. It looked like a pattern. Then Michael Saylor spoke. When asked about JP Morgan's $2.8 billion forced outflow warning, he didn't flinch. He called it alarmist. He said the real numbers were smaller and likely already priced in. He reminded everyone that MicroStrategy is an operating company, not a Bitcoin ETF. But most importantly, he zoomed out. He pointed out that bankers once refused Bitcoin. Accountants once refused Bitcoin. Politicians once refused Bitcoin, and one by one, they all eventually embraced it. He highlighted something the media ignored. The U.S. Treasury Secretary himself had just endorsed clearer crypto custody rules for banks, a 17-year milestone. And Saylor closed with this message. There are 1 billion people who want money they can hold themselves. This is bigger than any index, bigger than any bank. His calmness was the antidote to the chaos, and when the panic dust settled, the data told a very different story. 8% of the entire Bitcoin supply moved in 7 days, something that typically only happens at major bottoms. 5.8% of supply changed hands between 83K and 86K, massive accumulation from long-term holders. IBIT's most traded options were calls, institutions buying upside, not hedging downside. Long-term holder supply barely budged. Conviction stayed rock solid. Exchange balances hit new multi-year lows. People withdrew Bitcoin, not abandoned it. This wasn't a collapse. It was a transfer of ownership, from the fearful to the prepared. At that moment, a new chapter began. One where those who had prepared for the storm emerged stronger. The crossroads represented a choice, a pivotal point where fear transformed into wisdom. As the upward trend on the graph ignited hope, traders celebrated their strategic decisions, highlighting the resilience of the market. So what does all of this reveal? Not a conspiracy, not a coordinated attack, not some secret war between banks and Bitcoin maximalists. Something simpler, something more human. The legacy banking system is terrified of becoming irrelevant, and whenever Bitcoin strengthens, the system flinches. But Bitcoin doesn't need JP Morgan's approval. It doesn't need MSCI's index. It doesn't depend on margin desks or passive flows, because Bitcoin's foundation is simple self-custody, sovereignty, final settlement, property you can hold without permission. This moment, however messy, is just another reminder. If your Bitcoin depends on a bank, it isn't really yours. If your strategy depends on an index, it isn't really sovereign. And if your conviction depends on a news cycle, it isn't Bitcoin. Zoom out. Stay focused. And remember, there is no second best.